Hi everyone and welcome to this video. My name is Chris from Pell's Properties. In this video I will be talking about using leverage to the professional strategy to be more tax efficient. But there's three important areas we need to cover. We need to look at income tax, capital gains tax and inheritance tax. So in this video I'll be talking about income tax, and then there'll be two separate videos, one on capital gains and then one on inheritance tax. So this is a win-win situation. But before we start, let you write down two statements. First one is, never ever sell your investment property. And then the second one is, as a property goes up in value, increase your debt against it. Some of you might be a little nervous about this, but I will explain as I go along. So please also note that I'm not an accountant or an expert, but this strategy works for me, and you should always get your own expert advice from your own accountants, as all situations are different. So, did you know that most people are brought up to believe that debt is bad and savings is good? As a saver, they believe debt is bad, but as an investor, they understand that you can have debt which is good. Now I'll quickly explain the difference between the good debt and the bad debt, but if you would like to know more about this, there is a link at the bottom here where you can just click on that and it will take you to another video explaining more about the good debt, bad debt. Okay, so what is bad debt? Bad debt, it is, it's something which you will be paying for even if you're not using it. So for an example, if you went on a all-inclusive holiday for 2 weeks, once in a lifetime, you'll be paying this back. You go for 2 weeks, but then you might be paying this holiday back for years to come. Now that is a bad debt. Bad debt is also a car loan or a credit card or your overdraft. Now, all of these have very high interest rates to pay back, and then they are sometimes very hard to get out of a bad situation. So, okay, so what about a good debt? Well, a good debt has two criteria. First one is when somebody else pays for it. So this won't be you. This could be if you had another property, the tenant, through them paying the rent, will actually cover the mortgage on that property. And the second one is that it also makes you money on top of it. So, if you had good debt, how much good debt would you like? Okay, so let me show you how your property portfolio can be more tax efficient. Let's say we've got two people, Bob and Bill. Everything's the same between them. They've got the same job, they're on the same salary, they've got exactly the same identical house, they're in the same street. In fact, you could just say that they're twins. But let's say Bob, he hates debt, and he was brought up to be a saver and pay off his debts. But then if you look at the interest rates at a savings account at the moment, I think if you put about £1,000 in, over 40 months, you'll get £24. So these aren't really good, are they, at the moment? But anyway, so Bob, he wants to pay off his buy-to-let mortgage. He wants his own peace of mind, knowing that he's got no debts hanging over his head. So Bob is on a repayment mortgage. Bill, on the other hand, has an interest-only mortgage on his family let. So let's not forget that Bob and Bill have everything identical, except that Bob has a repayment mortgage. So he's paying off this £67,500 mortgage, while where Bill, he's just paying the interest on this £67,500 mortgage. So what happens if we fast forward for 15 years? Well, Bob's paid off this £67,500, where Bill has just been paying the mortgage. So what could he do with this extra £67,500? Well, he could have just bought 4 properties and he could be getting a lot more value out of these 4 properties because they'd be going up rather than just having the one. So it's another reason not to pay off your mortgage, because it will slow you down and it will further your growth. Okay. So what Bill has is his rent goes up every year. Okay. You should always put your rent up every year 3 to 5% every year without fail. So so what we're going to do, the rents will go up, let's say it's 30. So if they went up and somebody left, the tenant would leave anyway because you put the rents up. If it's £30 a month, no, they're not really going to leave. It's their home. They've been living there for a while, and for the sake of £30, they're quite happy to stay there. But anyway, over time, so the rent would have gone up to £650, £670, £690, £610. And then over time again, with inflation, obviously the maintenance has gone up £10, but that's not the only thing which would have gone up through inflation. Obviously the value of the house would have gone up. So if the value of the house has gone up, what we're going to do? We're going to go to the bank and say, hello, Mr. Bank Manager, my house is worth more money now. Can I please remortgage my house to the 75% of the new value? So the mortgage will go up, but that's absolutely fine because the rent's gone up, and then that rent will actually cover the mortgage. So as you've got an extra £60 a month coming in, you've got an extra £50 to £60 going out. So his net income remains the same. His income tax remains the same. So, like I said, if you followed what I said at the beginning, you know, as the property goes up in value, increase your debt against it, you'll always stay tax efficient. I hope you understand this. Obviously, you'd be putting the rent up, you'd be adding, as the value of the house goes up, you will be remortgaging it, so the mortgage will go up, but the rent will cover that. And obviously, over time, maintenance goes up, but you will always stay within the same tax bracket to become more tax efficient. Yep. Some of you might be thinking, Course 24 doesn't work exactly like that, but this is just a principle for now. But the principle held true with Class 24, and it makes sense. Okay. So this is the first video in a 3 videos of how to be tax efficient. So please like this or subscribe to my YouTube channel. Like I said, this is Chris from Pell's Properties. Invest with knowledge, invest in yourself, create your dream life.